Okay, I want you to imagine the scene with me for a second.
Hmm.
It is March 15th, 2008, and we are standing right in the belly of the beast. We're on a Wall Street trading floor.
The absolute epicenter of the financial world.
Exactly. And it is not a good day. Bear Stearns, this absolute titan of finance, a firm that survived the Great Depression, 2 world wars, it's just collapsed, literally overnight.
And it wasn't just a bankruptcy. I mean, that was the moment the psychology broke. It was the signal that no one was safe.
Right. The atmosphere isn't just tense, it's visceral. We're talking about seasoned hedge fund managers in full-blown panic mode.
Phones are ringing off the hook. You have people screaming orders.
There are literal stories of traders physically throwing up in their trash cans because the stress is so completely overwhelming.
Yeah, the senior partners at these massive firms, they're watching their net worth, and more importantly, their clients' net worth, just vaporize in real time.
It's chaos.
Total, unadulterated chaos. You know, the kind of market violence where you start wondering if the ATM down the street is going to work next week.
Except for one guy.
Right.
In the middle of this absolute maelstrom, there is one man sitting at his desk, completely still. He's not shouting into a phone. He's not sweating. He's not reacting at all.
Stanley Druckenmiller.
Exactly. Stanley Druckenmiller. And he wasn't calm because he was oblivious or, because he didn't get the gravity of what was happening.
You know, he was calm because he'd already seen it coming months and months ago.
While everyone else was scrambling, reacting to the disaster as it unfolded, he was just executing.
Yeah.
Executing a plan he'd written down when the skies were still blue.
And the result of that preparation was, it was just staggering. While his peers were losing everything, we're talking funds down 30, 40, 50%.
Wiped out.
He made $260 million in that chaos.
$260 million?
He didn't just survive, he thrived. He captured the very volatility that was destroying everyone else around him.
And that brings us to today. It's February 18th, 2026. And the whole reason we're doing this deep dive right now is that Druckenmiller is doing it again.
He is. He's displaying that exact same quiet confidence we saw back in 2008.
That's the hook, right?
It absolutely is. When a guy with his kind of track record, someone who hasn't had a down year in decades, who compounded at 30% annually for 30 years, when that guy starts positioning himself for what he calls a once-in-a-lifetime reset, you have to pay attention.
And his premise is that we're facing a situation that could be structurally worse than 2008.
Yeah, that's what's so jarring about it.
Worse than 2008. That's a heavy, heavy claim. 2008 was the near collapse of the entire global banking system.
Yeah.
How could he possibly argue that 2026 is potentially more dangerous?
Because in 2008, the government, and specifically the Fed, they had a relatively clean balance sheet. They had the capacity, the ammunition to step in and save us.
He could be the lender of last resort.
Exactly. His argument now is that the structural problems we face are fundamentally different because the savior, the U.S. government and the Federal Reserve, is now the one in distress. The patient is also the doctor.
Wow. That's a terrifying thought.
It is.
So here's our mission for today's deep dive.
Yeah.
We've got a massive stack of sources here. A deep forensic analysis of Druckenmiller's recent portfolio positioning, his public statements, and the hard data that he's looking at.
Right.
We are going to unpack the 3 warning signs
he
sees flashing bright red right now.
And we're going to break down the arithmetic. That's the key part. It's not just about sentiment or feelings. Sentiment lies. Arithmetic generally doesn't.
Right. And we aren't just going to talk about the doom and gloom. I want to be very clear about that. We're going to get to the so what.
Mm-hmm.
We're going to break down exactly how he is positioning his own portfolio, they calls his 5 buckets, to not just survive this, but to actually profit from it.
Because if he's right, the credibility trap that we find ourselves in is unlike anything we've seen in the last 40 years of financial history.
It's a fascinating, if somewhat terrifying puzzle to put together.
It really is. It challenges everything we've been taught about how markets are supposed to work, since the 1980s.
Let's get into it.
Let's do it.
Okay, so let's unpack this. Before we jump into the 3 specific warning signs, the debt, the liquidity, the trap, there's this one visual that Druckenmiller keeps coming back to.
Right.
It's a chart. And it's the thing that really explains the massive disconnect in the economy right now.
This is the foundation of his entire thesis. I really believe that. If you don't understand this one chart, the rest of it doesn't really make sense. It explains the cognitive dissonance everyone seems to be feeling.
Okay, so picture 2 lines on a graph.
Yeah.
Historically, for the last 30, 40 years, these 2 lines basically moved together. They held hands, When one went up, the other went up.
They tracked each other very closely.
But recently, starting around 2021 and really accelerating into 2026, they have violently split apart. I mean, it looks like a crocodile's mouth opening.
So that first line, the top line, represents confidence in the stock market, specifically how ordinary Americans and retail investors feel about equity prices.
How they feel about their 401k.
Exactly. Right now, in early 2026, that sentiment is at one of the highest readings in decades. It's actually higher than it was during the peak of the dot-com bubble in 2000.
Which is saying something. I mean, that was a time of extreme irrational euphoria. People were quitting their jobs to day trade pets.com.
Right. So point is, people love stocks right now. They think the market is invincible, that it only goes up.
Okay, so that's line one, euphoria. Now the second line.
The second line measures confidence in personal finances. This isn't some abstract concept like the economy. It's very specific. It's people answering questions like, can I pay my rent this month? Can I save for a car? What does my actual financial life look like 5 years from now?
And where is that line?
It's in the basement. I mean, it is scraping the floor. It is hovering near levels we last saw during major crises. Think the depths of 2008 or the stagflation misery of the late 1970s.
That is just wild. So you have maximum euphoria about the stock market, people thinking they're going to get rich on the next big tech stock.
Yeah.
But at the exact same time, maximum depression about their actual real-life checking accounts.
At the exact same moment. And Druckenmiller's point is that this isn't just some weird data quirk. He calls it a structural fracture.
A structural fracture.
Yeah, it's like a building that looks pristine from the outside. You know, fresh paint, nice windows, the landscaping is perfect. But if you go down to the basement with a flashlight, you see the concrete foundation has this massive crack running right through it.
But what is causing that crack? I mean, why is there such a massive difference between what we're calling Wall Street and Main Street right now? Because usually, if Wall Street is booming, at least some of that trickles down, right?
Right. You'd think so, but not this time. The source material highlights a really specific set of numbers to explain this divergence, and it's pretty startling when you see it.
Okay, wait on me.
If you look at the period from roughly 2010 to now, real personal income, so that's what you and I actually take home after you adjust for inflation, is up roughly 50%.
Okay, 50% growth over, what, 16 years?
Yeah.
That sounds okay. I mean, not great, barely 3% a year, but it's positive.
Right. Now compare that to the S&P 500. In that same period, also adjusted for inflation, the market is up nearly 300%.
Whoa. Wait, say that again?
Real income up 50%, the stock market up nearly 300%.
50 versus 300. That isn't a discrepancy.
That is not a gap, that is a canyon. That is the disconnect he's talking about. Asset prices have been inflated by monetary policy to a degree that has completely detached them from the underlying economic reality of the people who are supposed to be, buying the products these companies sell.
So the stock market has essentially become a simulation of an economy, not the economy itself.
Precisely. It's decoupled from the actual earnings power of the population. And here is why that matters so much. Markets don't just crash because things are bad. They crash when the distance between the price of assets and the reality of the economy becomes too wide to sustain.
The rubber band snaps.
The rubber band stretches and stretches, and it looks fine. Everyone's making money until it just snaps back violently. Duckenmiller calls it a stress fracture. You can't see it from the street, but the underlying integrity of the structure is gone.
So the foundation is cracked. That sets the stage for everything else. But, a crack in the foundation doesn't mean the house falls down tomorrow.
No.
You need a catalyst. You need gravity to do its work.
Right. And that brings us to the specific warning signs he's pointing to, the forces that are actively stressing that crack.
Let's get into warning sign number one, the death spiral. Now, I have to play devil's advocate here for a second.
Please.
We hear these big numbers all the time. The national debt is 30 trillion, it's 34 trillion, now it's pushing 40. After a while, it just sounds like noise,
It does. People tune it out.
People have been screaming about the debt since Reagan was in office. Why is this time different? Why should I actually care about the debt now when I haven't really had to care for the last 40 years?
It's a completely fair question. And the answer, the reason it's different now, lies in the shift from focusing on the principal, the total amount we owe to, focusing on the interest we have to pay on it.
Okay.
For 40 years, from the early 80s until very recently, interest rates were falling consistently. So even though we borrowed more and more money, the cost to service that debt stayed low, or even went down.
It was like getting a bigger and bigger mortgage, but your interest rate kept dropping, so your monthly payment stayed about the same.
That's a perfect analogy. We were refinancing into cheaper rates constantly, but that entire era is over. The United States government is now paying $1.1 trillion every single year, just in interest payments.
1.1 trillion.
Yeah.
It's just a number that's impossible to wrap your head around.
It is. So let me contextualize that for you. That is more money than the entire national defense budget.
Wait, are you serious?
100%.
We are spending more on interest payments to bondholders, China, Japan, Wall Street hedge funds, than we are on the Army, the Navy, the Air Force, the Marines, and the Space Force combined.
Yes. And think about what that money buys you. When you spend $1 trillion on defense, you get tanks and planes and geopolitical influence. When you spend on education, you get schools and, future workers.
Sure.
When you spend $1.1 trillion on interest, you get nothing. Absolutely nothing. You are simply paying for the privilege of having borrowed money in the past. It buys zero goods and zero services for the American people today. It is dead capital.
That is horrifying. It's like only paying the minimum on a credit card, but the balance just keeps going up anyway.
And that's exactly what's happening. And here is the spiral part of the death spiral. This is the mechanism that creates the trap. And it's a bit technical, but it is absolutely crucial to understand.
Okay.
It has to do with what's called the weighted average maturity of all that debt.
Weighted average maturity. Unpack that for me.
So the U.S. debt isn't just one big 30-year loan. It's a huge mix of 30-year bonds, 10-year notes, and a lot of very short-term bills, like 3-month or 6-month bills.
Okay, a mix of different due dates.
Right. Now, a smart CFO of a corporation, back when interest rates were near zero in 2020 or 2021, would have said, hey, money is basically free. Let's lock in these low rates for as long as possible, 30 years.
Of course. You refinance the house and get a 30-year fixed at 2.5%. It's a no-brainer.
But the U.S. Treasury didn't do that. For various reasons, to save a few pennies in the short term, they relied very heavily on issuing short-term debt. So now, the weighted average maturity of U.S. debt is surprisingly short. It's around 70 months.
Hold on. So you're saying the U.S. government didn't refinance its mortgage when rates were 2%. We effectively stayed in an adjustable rate mortgage.
Essentially, yes. A massive chunk of it. And that means a huge portion of our debt, trillions of dollars, is rolling over right now.
Yeah.
This isn't a problem for 2030. It's a problem for this Tuesday.
So every time a 2-year note that was issued in 2024 matures, we have to issue a brand new one to pay it back.
But we aren't borrowing at 2% anymore. We're borrowing at 5% or maybe higher.
So the mortgage payment is resetting. And it's resetting on a massive, massive scale.
That's the feedback loop. The more you owe, the more interest you have to pay. But to pay that interest, you have to borrow more money, which increases the total debt pile, which then increases the next interest payment, which means you have to borrow even more.
It's a spiral.
It is a death spiral. And Druckenmiller's core point here is that there is no natural exit mechanism for this. You can't just grow your way out of it when the interest bill is compounding that fast. The arithmetic is broken. And this is what economists call fiscal dominance.
Fiscal dominance. What's that?
It's the point where the government's interest bill becomes the single most important driver of everything. The Fed can't set interest rates based on inflation or employment anymore. They have to set rates just to keep the government solvent. The tail is now wagging the dog.
Wow. Okay, so that's warning sign number 1. The math of the debt is simply becoming impossible.
Right.
So let's move to warning sign number 2, the liquidity drain.
This is where we look at the plumbing of the financial system. And this is where a lot of people get confused because they look at the stock market indices, the Dow, the S&P, and they see green. They see all-time highs, and they think, well, there must be plenty of money around.
I love this analogy. We all look at the stock market like it's a scoreboard. If the score is high, our team must be winning.
But Druckenmiller is saying the plumbing underneath the stadium is leaking, and leaking badly.
So what is liquidity? In simple terms.
Liquidity is just the amount of money sloshing around in the system that allows people to buy assets. It's the oil in the engine. It makes everything run smoothly. And right now, we are seeing a massive historic drain of that oil.
There's a specific analogy the sources used here involving the company Apple that really it blew my mind. Can you break that down for us?
Yeah, it's a great way to visualize the sheer scale of the money that's disappearing. So you have 2 major vacuums sucking money out of the economy right now.
2 vacuums.
First, you have the U.S. Treasury. Because of that massive deficit we just talked about, they need to borrow about $2 trillion this year alone just to keep the lights on.
Okay, so that's $2 trillion being pulled out of the private sector, out of our bank accounts, and locked into government bonds. That's money that can't be used to buy stocks or build factories or hire people.
Correct. That's vacuum number one. Then you have the second vacuum. The Federal Reserve, they are doing what's called quantitative tightening, or QT.
We hear that term QT all the time. What is actually happening there? What are they doing?
Well, during the crisis, the Fed bought trillions of dollars of bonds to inject cash into the system. That was quantitative easing, or QE. Now they're doing the opposite. They are letting those bonds mature and roll off their balance sheet. They are effectively destroying money.
So they're not selling them, they're just letting them vanish.
Exactly. And they're shrinking their balance sheet by about $720 billion a year.
Okay, so let me do the math here. $2 trillion in Treasury borrowing plus another $720 billion in Fed QT. That's roughly $2.7 trillion leaving the financial system this year.
Exactly. Now, to put that $2.7 trillion in perspective, think about the company Apple, the biggest, most valuable company in the world. Its market cap fluctuates, but let's just say, for argument's sake, it's around $3 trillion.
Okay.
That liquidity drain we just calculated, $2.7 trillion, is effectively the same as the entire company of Apple vanishing from the financial system every single year.
That really puts it in perspective. We are deleting an Apple's worth of money from the poker table every 12 months.
And yet, people are surprised when things start to break. You cannot remove that much lubricant from the engine without the gears starting to grind.
But hold on a minute. If we are draining an Apple's worth of cash from the system every single year, why hasn't the market crashed yet? We're still near all-time highs. Is Druckenmiller just wrong, or is there a lag effect?
He argues there's a lag. These liquidity drains, they happen in stages. It doesn't all vanish overnight. There was this huge reservoir of excess cash left over from all the COVID stimulus that's been acting like a buffer. But that buffer is running dry.
And what are the stages of the drain? How does it play out?
Stage one is what he calls the fragile break. You see the stress in the weakest links of the chain first. That's your small cap stocks, your regional banks, and commercial real estate.
Right, and we've already seen that. The regional banks have been screaming for help for over a year. We saw it with Silicon Valley Bank, First Republic, and that problem hasn't gone away.
Not at all, because those entities need cheap, easy money to survive. So that's stage one. Stage two is when the cracks start to spread to adjacent areas. The slightly stronger companies start to wobble because their customers, the weaker ones, are going broke. And then stage three is the sudden systemic collapse.
And where are we now?
He says we are currently in the slow drain phase. We're in stage one, maybe bleeding into stage two. The cracks are clearly visible if you're willing to look. Look at commercial real estate valuations. Office buildings in major cities are selling for 50–60% off. Look at the balance sheets of the smaller banks. But the headline, S&P 500, is masking all that rot.
Why?
Because it's dominated by a handful of massive tech companies that are sitting on mountains of cash. They're strong enough to weather it for a while.
It's like the termites are eating the wooden beams of the house, but the fresh coat of paint still looks nice. The tech giants are the paint.
That is a perfect analogy. But eventually, the termites eat enough of the structural beams that the roof caves in, regardless of how nice the paint looks.
Okay, so we've got the debt spiral and the liquidity drain. That's pretty grim. But here's where it gets really interesting for me. This is warning sign number 3, the credibility trap.
This is the checkmate scenario. This is the piece of the puzzle that brings it all together and explains why this time is different.
And this is the part that, explains why that phrase, this time is different, which is usually the most dangerous phrase in finance, might actually apply here. His argument is incredibly compelling.
It is. Think about the last 40 years of financial crises. You have the 1987 crash, the dot-com bust in 2000, the great financial crisis in 2008, the COVID crash in 2020. Every single time the market panicked, what was the playbook?
Simple. The market crashed, everyone panicked, and then the Federal Reserve came riding in on a white horse, cut interest rates to zero, and fired up the money printer. A mountain of money.
And it worked.
It worked every single time. It was the escape hatch, the Fed put, they call it. The unspoken guarantee that if things got bad enough, the Fed would always be there to bail out the markets.
Right. So why can't they just do that again? If the market drops 20% tomorrow, why doesn't Jerome Powell just go on TV and fire up the printer?
Because the escape hatch is jammed shut. And it's jammed by inflation on one side and the national debt on the other. This is the credibility trap.
Let's play this out. Let's run the scenarios. Scenario A. The market crashes, say 20 or 25%, and the Fed panics. They do what they've always done. They cut rates back to zero to save the stock market. What happens next?
Well, inflation, which is currently sitting stickily above 3%, would just explode.
It would go parabolic. You have to remember, inflation is psychological at its core. If the public sees that the Fed will abandon its inflation fight and print money every single time stocks drop, they lose all faith in the currency. Inflation doesn't just go to 4 or 5%, it goes right back to 8, 9, maybe even higher.
And we all know what that looks like. We just lived through it in 2022. It absolutely destroys the middle class. It crushes purchasing power.
And it risks genuine social instability. People can handle their 401k going down. They cannot handle not being able to afford food and gas. So scenario A is a potential disaster for the currency and for society.
Okay, that sounds bad. So let's try scenario B. The Fed says we can't have inflation. We are Paul Volcker 2.0. So they stay tough. They keep rates high to fight inflation, even as the economy slows down and the market drops.
Then you go right back to warning sign number 1.
The debt spiral.
The debt spiral. If rates stay high, that $1.1 trillion interest bill compounds uncontrollably. The federal budget gets completely crushed. The economy suffocates because all the available capital is going to service old debt. And eventually, the government itself is forced to default, not explicitly maybe, but by restructuring its promises.
So they damned if they do and damned if they don't.
That is the trap. For the first time in 40 years, the firefighters have run out of water. If they spray water, which is printing money, they just fuel the inflation fire. If they don't spray water, the building burns to the ground from the debt.
And the market is currently pricing in a rescue, isn't it? It assumes the Fed will save the day because they always have.
The market has been trained like Pavlov's dog for 40 years. Druckenmiller is betting that the math says a rescue is impossible this time without triggering a full-blown currency crisis.
That is a chilling realization. The Fed the idea that the Fed will always be there to save your portfolio might actually be dead.
Or if it's not dead, the cost of using it will be so high in terms of inflation that the portfolio they save won't be worth anything anyway. I mean, if your portfolio doubles but a loaf of bread costs $50, are you really any richer?
No, you're just holding more paper.
Exactly.
So what does this all mean for us? I mean, we've painted this picture of a massive storm brewing. But before we get to the solution to his portfolio, we have to talk about the psychology of all this.
Right.
Because Druckenmiller has been bearish for a little while now, hasn't he?
He has. He's been warning about these structural issues for a couple of years.
And the critics, they jump on that. They say, oh, look, he's been warning about this for 2 years, and the S&P went up another 20%. He missed the rally. Was he wrong?
This is such a crucial distinction he makes. It's the difference between being early and being wrong. And this is something every single listener needs to internalize.
Unpack that for us. Being early versus being wrong.
Okay, so back in 1999, during the peak of the tech bubble, Druckenmiller thought the market was completely insane, and he was right. He started shorting tech stocks.
He was too early.
He was about 12 months too early. The market kept going up. The insanity got even more insane. He lost some money, and he said it was incredibly painful. He even capitulated right at the top and bought some tech stocks, which he calls the biggest mistake of his career.
Wow, so the FOMO, the fear of missing out, even got to him.
It did. But because he recognized the error so quickly and got defensive again, when the turn finally happened in 2000 and 2001, he made an absolute fortune. He survived. The people who mocked him for being early got wiped out.
It's the asymmetry of risk.
That's it, exactly. Look at the simple math of recovery. People forget this all the time. If you are defensive a little bit early and the market goes up another 10 or 15%, what have you really lost?
You missed out on some paper gains. It's a paper cut. You feel a bit stupid at the cocktail party, but you're fine.
Annoying, but you live to fight another day. You still have all your capital. But if you are fully invested and maybe even leveraged when the drop finally hits, when that structural fracture finally snaps, you don't lose 10%, you might lose 50%.
And here's the math that just kills you. If you lose 50% of your money, what return do you need just to get back to even?
You need a 100% gain. You have to double your money just to get back to where you started. That can take a decade. That's not a paper cut. That's a severed artery.
So he's willing to look a little foolish for a year to avoid being ruined for a decade.
It's about avoiding the ego trap. Smart people go broke because they have an emotional need to be right now. They need that daily validation. Druckenmiller has a rule. When the facts change, you change your strategy. Immediately. There's no expensive storytelling.
I love that phrase, expensive storytelling. We all do that, don't we? We buy a stock, it goes down 20%, and we invent a new story for why it's a good investment.
Oh, they're restructuring. It's a long-term hold now?
Right. It's not a real loss until I sell. That's the narrative we tell ourselves.
Druckenmiller says you have to kill the narrative. Look at the numbers. Sometimes the highest ROI activity you can do is just sit on your hands, do nothing, and wait patiently for what he calls the fat pitch.
So let's talk about that fat pitch, because Druckenmiller isn't just sitting in cash and hiding under his bed. He has a very specific, actionable plan.
He does.
He breaks his current portfolio down into 5 buckets, and I want to go deep on these because this is the actual playbook.
This is the actionable part of the whole thesis. He isn't just guessing, he is positioning.
Let's go through them one by one. Bucket number 1, cash and short-term treasuries. This is a huge position for him, about 35% of his allocation.
Now, in a high inflation world, most people hate cash. They call it trash. They say it's losing value every single day just sitting there because of inflation.
Yeah, cash is for losers. That was the mantra of the entire last decade.
Druckenmiller reframes this completely. He says cash is not lazy, cash is optionality.
Optionality. Explain what he means by that.
When the crash comes, when that liquidity drain hits stage 3, and everyone is selling everything that isn't nailed down, what is the most valuable resource in the entire world? It's not gold, it's not Bitcoin, it's liquidity. It's the ability to buy.
So holding cash is like buying a call option on the entire world going on a fire sale.
That is the perfect way to put it.
Yeah.
It allows you to walk into the wreckage and buy incredible assets, blue chip companies, prime real estate for 20 cents on the dollar because you are the only one with the cash to close the deal.
While everyone else is getting margin called.
They're being forced to sell, you're choosing to buy. In 2008, he had the cash. That's why he could buy when everyone else was selling. He wasn't the one getting the margin call. He was the one answering the phone.
Okay, that's bucket 1. That's the ammunition. Let's talk bucket number 2. Short positions. This is roughly 25%. This seems incredibly risky to me. Shorting has infinite risk, right? If the stock goes up, your losses are theoretically unlimited.
It is an aggressive posture. But you have to look at what he is shorting. He isn't shorting great companies like Microsoft. He is specifically targeting the fragile, the zombie companies.
Find a zombie company for me.
A zombie company is a company that cannot pay the interest on its existing debt from its own operating cash flow.
So they literally have to borrow new money just to pay the interest on the money they already borrowed.
Exactly. And these business models only worked when interest rates were 0. When money was free, you could stay alive as a zombie forever. Now that money costs 5%, they are structurally insolvent. It's just a matter of time.
And he's also targeting commercial real estate in this bucket, right?
Yes. Think about the office market. You have buildings that are 40–50% empty because of the shift to remote work. But the massive debt on those buildings is coming due, and they have to refinance.
And the building is worth less, and the interest rate is double or triple what it was.
The math just doesn't work. The equity in those buildings is a 0. He is betting that these things will go to their intrinsic value, which is 0.
So he's shorting the things that absolutely required free money to exist.
Precisely. The beneficiaries of the bubble are the victims of the bust.
Okay. Bucket number 3, gold and gold miners. This is about 20% of the portfolio. Now, gold bugs, we all know them. They usually wear tinfoil hats and hoard canned beans in their basement.
Yeah.
Is Stanley Druckenmiller becoming a gold bug?
He's not looking at it religiously. He's looking at it pragmatically. He sees it as a currency alternative. This is the trust hedge.
But why gold? It feels so old school. Isn't Bitcoin the new digital gold?
We'll get to crypto in a second. But for Druckenmiller, gold has a 5,000-year history of being the asset you own when you don't trust the government to manage its currency. Gold doesn't rely on a government promise. It doesn't rely on the Federal Reserve's credibility.
So if the credibility trap we talked about finally springs,
and people lose faith in the central bank's ability to protect the value of the dollar, gold wins. And look, it's not just him. Central banks around the world, China, Russia, India, they are buying physical gold at record paces. They are actively diversifying away from the US dollar. He is just following the big money.
and he uses the miners for leverage, right? Explain the mechanics of that, because that's really interesting.
This is key. He isn't just buying bars of gold and sticking them in a vault. He's buying the companies that dig the gold out of the ground.
Right.
It's all about operating leverage.
Okay, how does that work?
Let's use simple numbers. Say it costs a mining company $1,500 to pull 1 ounce of gold out of the ground. That's their all-in, fixed-cost labor, diesel for the trucks, equipment.
Okay, $1,500.
And let's say gold is trading at $2,000 an ounce. So they make $500 profit per ounce.
Simple math.
Now imagine the price of gold goes up just 10% to $2,200.
Okay, that's a pretty small move for a commodity.
Right. But the miners' costs are still $1,500. So now their profit is $700 per ounce. Their profit just went from $500 to $700.
That's a 40% increase in profit.
Exactly. The price of gold moved 10%, but the miners' profit moved 40%. That is the power of leverage. So if gold goes on a real run, these stocks can double, triple, or more very, very quickly.
But miners are notoriously risky businesses, aren't they?
Oh, they're terrible businesses generally. Mines flood, governments in unstable countries nationalize them, fuel costs go up. This is a tactical trade for him, not a marriage. He's renting them for the potential explosion, and then he'll get out.
Got it. Okay, bucket number 4, energy. This is oil, gas, and uranium. About 10% of the portfolio.
This connects right back to inflation and supply. The Fed can print dollars. They can create trillions of dollars with a computer stroke, but the Fed cannot print a barrel of oil.
That's a great line. You can't print oil.
It's true. We have had a decade of underinvestment in energy infrastructure, partly because of ESG mandates and partly because of low prices in the past. We haven't built enough wells or refineries, so the supply is very, very tight.
And if the economy recovers, or even if it just treads water, we need energy. It's the lifeblood of everything.
Hard assets always win when inflation returns. If the dollar is being debased, you want to own things that are scarce, essential, and priced in dollars. If the value of the dollar goes down, the price of a barrel of oil in dollars goes up. It's a natural hedge against currency debasement.
And finally, bucket number 5, defensive consumer staples. This is the remaining 10%.
This is the boring stuff. Toothpaste, soap, food, cigarettes. The things people buy no matter what.
So why bother with the boring stuff? If he's looking for these big asymmetric returns, why buy a toothpaste stock?
Because even in a Great Depression, people brush their teeth. Even if they lose their job, they buy soap for their kids. These companies have incredibly consistent cash flow, and more importantly, they have pricing power.
Pricing power.
If inflation goes up 5%, Colgate can raise the price of toothpaste by 5%. And you'll complain, but you'll still buy it. So their earnings keep up with inflation. These stocks are the ballast in the ship. They keep you steady while the high-flying growth stocks are capsizing. And they pay you dividends, which gives you cash flow while you wait for the storm to pass.
Speaking of growth stocks, let's talk for a second about what is absent from this list, because that is just as telling as what is actually in it.
It's stark, isn't it? There is no mega-cap tech, no NVIDIA, no Microsoft, no Apple, no high-flying software as a service companies, and very notably, for the modern investor, there is no crypto.
Wait, so that is basically the entire portfolio of the average retail investor right now. The Magnificent Seven, tech stocks, and Bitcoin. That's the whole trade for most people.
Which is exactly his point. This is not a portfolio designed for fear of missing out, for FOMO. It is a portfolio engineered for survival, and after that, for opportunistic attack.
So his bet is that the assets that worked for the last decade,
the zero interest rate beneficiaries, are exactly the things that will get crushed in the reset he sees coming.
It's a masterclass in being a contrarian. He is betting directly against the most crowded trades on the planet.
He is positioning for a world where money has a cost again. Tech stocks are what's called long-duration assets. Their valuation is based on profits far out in the future. When interest rates are high, those future profits are worth much less today. It's just math.
So, bringing this all to a conclusion here, we have the structural fracture, that massive disconnect between the market and reality. We have the 3 warning signs, the debt spiral, the liquidity drain, the credibility trap. And we have a very specific 5-bucket portfolio to handle it. What is the timeline here? What's the urgency?
The scary part isn't the crash itself, it's the timing. And Druckenmiller emphasizes that these warning signs are visible now, today, in February 2026. That refinancing wall for corporations and the government that we talked about is hitting this year and next year.
So the window of opportunity to prepare is open, but it might be closing.
I think so. The transition from isolated incidents, like a regional bank failing here or a real estate fund blowing up there, to systemic failure happens much, much faster than people expect.
It's like a dam breaking.
That's the perfect analogy. You see a few cracks, you see a little water spurting out, and then suddenly the structural integrity fails and the entire wall of water just gives way.
And the narrative will shift, won't it? Because right now, the mainstream financial news is telling us soft landing, Goldilocks economy, everything is fine.
Oh, absolutely. When the early drops happen, the media will call it contained. They will tell you it's a healthy correction and a buying opportunity. They will interview experts who tell you the fundamentals are strong.
Just like they did in early 2008. Subprime is contained. That was the famous line.
Exactly. The winners of the next 5 years won't be the optimists who listen to the TV. The winners will be the realists who did the math.
It's a sobering thought, but it's also empowering. Because if you see it coming, you aren't a victim of it. You have agency. You can prepare.
Knowledge is the only real hedge. If you understand the mechanics of what's happening, you don't panic. You execute your plan. Just like Druckenmiller did in March of 2008.
I want to leave our listeners with a final provocative thought, something to really chew on as they, look at their own 401ks tonight.
Let's go back to the arithmetic. Forget the politics for a minute. Forget who is president. Forget the headlines. Just look at that $1.1 trillion interest bill and the logic of the credibility trap.
Okay.
If Stanley Druckenmiller is right, and that rescue escape hatch, the Fed coming to save us with low rates and money printing, is jammed shut for the first time in 40 years because of inflation, then ask yourself this one question.
What is it?
What is the one asset in your own life that you are holding purely based on the belief that the Fed will fix it?
Wow. That is the question, isn't it? Is the price of your house, is your stock portfolio, is your crypto holding, is it dependent on a rescue that might never come this time?
And if the answer is yes, if you are implicitly betting on a bailout, you might want to look at those 5 buckets again. Because the firefighter might not be coming this time.
Stanley Druckenmiller is betting on a reset. The question is, are you prepared to bet against him? That's all for this deep dive. We'll catch you on the next one.
Stay curious.
And stay solvent. See ya.